Hello and welcome to this video on equity markets in the 70s and the lessons for today. Current high inflation reminds many people of the inflation of the 70s. The S&P 500 stock index had almost halved around the 1973 oil price crisis. In the years thereafter, equity prices recovered, but on balance, US stock prices barely rose in the 70s. Adjusted for the high inflation, investors made a clear loss. This was not primarily caused by disappointing corporate earnings. Companies increased their profits in the 70s, even outpacing inflation. Instead, the weak performance of equity prices was mainly due to a falling valuation, that means a falling price-earnings ratio. High inflation at the time represented a huge uncertainty. People were holding back on saving and investment. This uncertainty caused PE ratios to fall. Looking ahead, it must be noted that inflation is currently already very high, and the ECB is reluctant to act decisively because it is under pressure of the highly indebted countries. That's why we systematically expect inflation rates markedly above the ECB's 2% target in the coming years. Historical comparisons are of course not easy, but if inflation were to remain high in the coming years, the environment for equities would become much more challenging. Investors will have to become more active and be prepared, for example, to realize profits after strong price gains.